All right, we'll get going. Just give me a moment. Good morning, good afternoon. Okay, let's make sure we have no tech troubles. All audio, video, everything is okay. Screen sharing is okay. It doesn't matter how many times we use these technologies. There will be days, there will be moments when we'll be talking, and then suddenly you hear, hey, are you saying anything? We're not able to hear you. Or are you sharing anything? We are not able to see. So it's always good to check if we don't have any of those troubles. So all good. Okay, cool, nice. All right. I'll make sure I got everything. Okay, all set. Recording is on. Cool. So yeah, pretty busy week. I would say for me, not on the market perspective, but from a work perspective. We run our financial year finishes in January, and then also team reviews and all that. So all pretty much had to be wrapped up by this week. So it was a pretty busy week. And of course, in the markets also, a lot of the earnings are still, a lot of earnings still going on. And that's what I want to put some focus on is look at various earnings. Let's see, Samuel said, do you own SoFi? Any thoughts on Oracle? I do not own SoFi as of now, because I mean, SoFi came in during the high time of 2021 or 20, yeah, I think it's 2020 or 2021. I thought it was too highly from a valuation perspective, it was super expensive for what they were doing. Started as a student loan, and then of course there were challenges around when the student loan moratorium was placed. Then they moved into different business segments. They moved into what do you call as a banking as a service segment. They also purchased Galileo, and I think over the past many months, maybe now it has come to a price point where it might be more attractive, but I haven't spent any time on looking at SoFi 3 months. Okay, let's look at. Okay, it's been all right. It's been 20, 26, and now I think it's back to 6 if you look at SoFi. But now I may be interested, but right now, again, I'm not looking to add any more ticker in my portfolio. So I'm
excuse me, Vivek.
Yeah.
You don't have to talk about it. Our friend in Florida, one of his people said it's kind of junk.
Yeah, I wouldn't dismiss the stock without knowing about it. So I haven't spent much time.
He compared it to another bank, but he more or less he said it's junk. That's why I said I just asked you whether you owned it or not.
No, I never owned it.
Oh, Kramer likes it.
Yeah. There's a Kramer, there's an inverse Kramer ETF also. So, so I don't know, whatever Kramer like that. Yeah, maybe he likes it. I have not studied it. I don't own it. Oracle, yes, I'm bullish on Oracle. I had owned Oracle, but I think I sold it off because I was cleaning up one of my brokerage account in which I held Oracle, but I want to get back in Oracle. When it's a time to add more tickers, so Oracle is on my list, especially because they've been doing some good work on the Oracle cloud side. So that's the only reason why I would want to own Oracle, because companies like Oracle, Google, and maybe IBM, but not so sure yet, but especially Oracle and Google are becoming a competitors, I would say, that you cannot ignore when it comes to your cloud space. And recently, Oracle also have some big brands that have moved to Oracle Cloud. They got TikTok, they got Zoom, they have, I think Uber moved to Oracle, they have 8x8. And also they did a recent acquisition of a healthcare company. They want to be big in terms of cloud software for storing healthcare data, right? When it comes to some of these regulated data like healthcare data, having or being the first in getting through all the regulatory clearances might bode out well for a long term. So Oracle, I'm bullish on, but yes, I don't own it right now. But that's something which I do want to own when I want to add more ticker to my portfolio. Still says, I have 100 shares that have been great disappointment, assigned so far 22 and barely above 6 now. Yeah, as we can say, it's just around 6. Ramesh took loss, not chasing BTN, pay never stock. Okay, buy today, pay never. Oracle is good. Yeah, Oracle has been, it has been good for me as well. But like I said, right now I don't own Oracle. Right. Going back to our today's agenda. All right, let's guess is what are the earnings that we're going to go through today? Some of them, I guess, are pretty recognizable logos. Hopefully, some of you will be able to guess what those are. There are 6 companies I want to talk about today from earnings perspective. Any guesses? What are these 6? And then, of course,
I could see the first 2. And I only use Airbnb, which was not a pleasant experience.
Okay, all right. So yes, there is Airbnb. Other one is, come on, any guesses? I know many of you know about this. Maybe a little shy. All right, so we'll get to it when we'll get to it. Meantime, if you do want to share what are these companies, yeah, please put it in the chat. And I also want to talk about a few option strategies. Going back to basics of options is, when the times are uncertain, when we are a little jittery about the markets, but of course, on a long time, I'm bullish. So what are some of the strategies that we can use? Some of these have worked well for me, 2022 especially, and so far in 2023. So I do want to talk about that. And of course, a little bit of what's in the market, etc. So that's going to be overall agenda for today, unless you have something else that you want to talk about. Right. Ramesh Kramer is his buddy and introduced him to him during his vet show. His buddy means who's Anthony Notos. I think Anthony Noto is the CEO of SoFi, if I'm not wrong. I don't own, so but let's see. SoFi is CEO. Mr. Noto, yes, okay. Yeah, so he was earlier in Twitter. I think maybe he was CEO or some CX suit in Twitter. I knew that name from then, and then looks like he moved to SoFi. Anyway, so we're gonna review a bunch of earnings, and this is going to be a little deep session. As you know, I don't just skim over. I do want to look at earnings. I do want to focus on what's happening in the business of the company. And then we'll look at the charts, right? And of course, we'll talk about options and how to use, these option strategies while we are waiting for markets to do what the market will do. All right, so let's dive into it. Okay, so before we go, today morning, I was just scrolling through the Twitter, and I came across a wonderful tweet from Sahil, which is around the Feynman technique of learning anything. Identify a topic, explain it to 5-year-old, study to fill in the knowledge gaps, because surprisingly, people who don't know about a topic will ask you a question that will surprise us, and then you go back, study, organize, convey your views, right? And someone had asked me earlier why we're doing these sessions. I said the best way to learn is to start teaching. So that's why my weekly mantra is learn something new every week. And for me, I've decided to learn in the markets, because markets changes every day, and there's always something new that you can learn. So every week I learn something, I spend time, and I come here, I talk to you. You guys come ask questions, go back. I say, oh, I don't know about this. Maybe I'll go back and find more about it. Right now, the questions. SoFi, no, I don't know much about SoFi. I haven't owned it. I haven't done deep analysis into SoFi. I have some idea about its business, but yeah, if it interests is more, maybe we can go and do some deep dive in SoFi. Right. So learn something new. Come and teach friend, community, family. Talk about these things and fill in the gaps. Go back, study more. That's my weekly mantra. Let's see. Hopefully, I'll continue this for as long as my mental faculty allows. That's my I would say agenda for life. Let's stay active. Let's learn something new every week. So, looking at the overall markets, this was a chart as of Friday. If you really look at the chart with the biggies all down, we would be thinking that, oh, the markets really didn't, probably didn't perform that well. So we saw a sharp downturn, maybe near, at least on, I don't know what happened on Thursday, near the closure or the second half. I did look at the markets in the morning. It's all okay. Then, got into work meetings and all that. But when the market closed, I saw what the heck happened. What the heck? Suddenly NASDAQ was down. All the big indexes were down. I don't know, something changed on Thursday that market suddenly moved its direction. And same case on Friday. And again, I wasn't watching till the end. I generally get some time to spend early in the morning before I get back to the work meetings. But all I realized the market was too volatile. Eventually, today morning when I looked at it, took this chart, okay, all these biggies are down, and I would think maybe NASDAQ probably closed down for a week. But when I look at the numbers, I'll come back to this. NASDAQ actually closed higher for the week, which was, And then I try to verify it, and it's really true. The NASDAQ actually closed higher for the week. Of course, Dow Jones and the S&P were slightly down. Last week, Dow Jones was up 2.18% year to date. Now it is only 2.05, but still up. But still, NASDAQ, mid-cap, Russell, they all are green for the week. And year to date, 13% performance is great. I mean, it was 16%, and I still think it's too much too soon. So I'm not going all out and deploying all the dry powder. I'll still continue to do the regular investment, no change in suddenly, becoming bullish or suddenly taking a very bearish note. Just still staying to our regular investment and wait what market will do and when it will probably start to recover. Right? But this was a pleasant surprise. Looking at the chart, I wouldn't have realized that NASDAQ actually closed higher for the week. Right? But another thing that surprised me, and this is like 5 minutes ago, I took this chart, looks like are we back on risk on? I mean, look at Bitcoin up 14% for a week. It's higher than 24,500. And Ethereum is already touching like $1,700. And this despite so much of regulatory crackdown that we have seen over this whole week. If you are active on crypto Twitter, you might have heard a phrase called a crackdown. No, not crackdown. What? Choke point 2.0. That's what the government and the regulatory bodies are doing. So I wouldn't have expected with the choke point 2.0 going around, the volatile asset class or the crypto asset class to be, all ended green, and not just green, but doing superbly well this week. So now little bit of it started to diverge from NASDAQ, maybe at least for this week. We see these like huge gains on Bitcoin and Ethereum. So anyway, in some portion of the market, looks like we're back to we're okay to take more risk on the crypto side, but not yet on the stock market side. But still a lot more to recover, right? At some point, the highest point for Bitcoin was a 67,000. So still 66%, 2/3, maybe 60% drawdown from its all-time high. And so is the case with a lot of other stocks as well. Right? Even though this year NASDAQ has been up 12.62%, many stocks in the NASDAQ and the big ones like Facebooks of the world, Googles of the world, Amazons of the world are still down 25, 30, 40% from all-time high. It's a lot more recovery still to be done. In any case, overall, the sector overview, consumer discretionary was the topmost, and energy was the worst performing sector. I don't know what happened. I didn't track anything around energy. So if some of you know what might have caused this, only thing I knew about that government had decided to release a few million barrels of oil from our SPR reserves. Beyond that, I don't know. I might have missed. Like I said, it was a pretty busy week from work perspective. Anyone who tracks energy much closer than me can share the thoughts on what happened to energy. I mean, it's down almost 7%, which is a huge move. So last week, that was the only sector of S&P that ended in green. And this week, this is the worst one. And well, who cares if it is just 1 week? So, but I was a little curious on what the heck happened. Anyway, fear and greed index still firmly in the greed side. Again, this is all based on, if you go to the CNN website, they do explain the methodology of how they come to these numbers. But so far, I mean, these numbers have been, I would say, have been being accurate or being able to tell, that we are in euphoric, little euphoria going around here. Yeah. So what else happened? Buys and sells, like every week, if I make some long position, buy or sell stock, I do want to share. I bought EEMTLT Google, GOOGL, and sold LIT, which is lithium ETF. Again, like I explained last week, I sold FCX, one less ticker to track. This week, I sold LIT. Wasn't a too big a position anyway. I really, over the days now, I realize I'm not really that good in, on the commodity side. And then LIT, even though it's an ETF, very thinly traded and huge, very wide bid-ask spread. So nothing, reducing cost basis is a challenge, even though at least when I said, okay, I'm able to get out even or with a scratch profit, let me reduce one ticker in my portfolio, right? So yeah, my average buy cost was 77, right? And after that, it's all it done is gone southwards, So, but I bought it almost exactly a year ago, and been selling premium. So I would say it's a scratch, just got out of a scratch. Well, that's fine. One less ticker. And if I want to get exposure to more metals, I'll probably go through XLB ETF, because that is a lot more liquid and much better from options perspective, much better ticker to work on. So yeah, I got into lithium with the whole hope of, the whole idea around electric cars will need a lot of lithium, and hence there will be a need for lithium, and lithium mining companies will do good and all that. Yes, commodities, work differently, and we really need to understand how the cycles work out. I haven't spent much time on commodity, and so rather pick up better ETF than LIT. All right, before we jump into earnings, always want to focus on mindset and the behavioral part of investing, because I think that is way more important than finding a great ticker, right? Anyone and everyone can find a great ticker. You can subscribe to many of I would say stock recommendation services, which include both technical and fundamental. You can find out, we would have known about Amazon when Amazon was like $9, $10. You would have known about Microsoft when Microsoft was $40, right? But if our mindset wasn't correct, if we are not from a investing as a behavior perspective, if we are not grounded, our feet are not grounded, then really those positions will never be able to make money. So do want to focus on building the right mindset for investing. So 5 charts I do want to share. One is history of a stock market. And for me, the market is not a tick. It is, like I always say, human ingenuity will always move forward. And this is what the stock market is, nothing but a representation of human ingenuity. Right? Way from 1896 all the way till 2020. And I don't have to tell how many pandemics would have come, Spanish flu, whatnot, couple of big world wars, depression era, dot-com burst, and probably maybe some worse situations, Spanish flu and whatnot. How does it matter? Human ingenuity will always move forward. And that's why I love to be active on the market. Right? What else? Psychology cycle. This is something I think which we have seen playing out in 2020, 2021, 2022. This is the peak of our 2021. Every SPAC stock listing at 10, going all the way to 15. Many companies, no revenue being valued at multiples of billions of dollars. Nothing could go wrong. That was our euphoria. And then denial, panic. Right now we're sitting here saying, oh, it's not gonna, depression, we don't have money, markets are never gonna recover. We still have a lot more to lose, and probably could, right? But markets always go through these cycles, and it's not the first time that's happening. I heard someone say, which was, I was really impressed. It's if you want to learn about what market is going to do, don't try to figure out what S&P etc. are going to do in future. Just go and learn about the history. Okay? Everything is unprecedented if we don't know about history. If you have not learned or read about history, everything is unprecedented. Right? But the reality is, whatever we are seeing has happened many times before. So it's not unprecedented. But while we are going through it, it's like, oh gosh, why is it happening? I don't think it would have ever happened earlier, but now these things have happened many times, as this chart has shown, right? So third one, we do find time and time again many smart reasons on why we should sell the stock. Could be recession, could be rising interest rate, could be riots, could be savings and loan crisis over here, government shutdown, so on and so forth. And it's eventually, these things will take care of itself. And I think now, okay, fourth one is leaderboard changes after every decade. And I think someone had asked earlier that why do I own, let's say, QQQ or SPY when I have a lot of single stock position also? Because I do own Apple. Again, I think top 5 positions, I got Apple, I got Google, which are also part of the S&P. But I don't know how the leaderboard will change 10 years down the line. Right? So I do want to have a substantial portion of my portfolio in a large cap index, because today Google, Apple, they are ruling the S&P 500. They're on the top. 15 years down the line, I have no idea which one will come up. If you look at 10 years ago, ExxonMobil was number 1. Now it's not even there in top 10 companies. Right? Completely vanished out of top 10. Other AT&T, General Electric, none of them are there. So I don't know. Even though I'm bullish about Let's Go, but I don't know whether they'll continue to stay as the top companies or not, right? Microsoft, Apple, Alphabet, Amazon, these are right now, these are the biggies of S&P 500. 15 years down the line, I have no idea. Okay. So that's why, at least for me, it's S&P 500 SPY ETF is still, that's the reason it is. I want to keep that as the top holding in my portfolio, because we don't know when the leaders will change. But overall, S&P 500 or overall economy or human ingenuity collectively will move forward. Maybe Google will fall off. I don't know. Maybe government regulations will rein in all this big tech. In that case, this big tech will no longer be, let's say, 10 years down the line, that big tech may no longer be, on the top. Impossible to guess. So that's the reason why I want to hold S&P 500 as a big part in my portfolio. And finally, this one, compounding is the 8th wonder. Everyone reads about compounding in middle school, but we still haven't learned the lesson. So an interesting chart around, if a dollar doubles every year, in 20 years, where we end up. And the other one where you look at it, you pay 25% tax. And this is one reason why I have a hard time in selling the stock, just because the stock has gone down, is, you sell it, you incur tax and all that. And then over a long period of time, I don't want to lose on that big compounding impact. We really don't, mentally, a human brain cannot think in exponential terms. We are wired biologically to think in linear terms. But compounding is an exponential or works on a logarithmic scale. And unless we have the charts in front of us, or these data point in front of us, we just don't realize what the compounding effect could be. So the right column talks about, you made money or you sell it, but it's at a taxable at 25%. Start with $2 and continue to pay taxes and reinvest that, and you still double it. You end up at $72,000. Not bad, but let the compounding do its magic. the difference is huge. But that doesn't mean that, especially from my perspective, I, cognizant of the fact that 25% of the stock probably will go down to zero, whatever I own, but I'm okay to take that risk. Okay. So compounding, gotta keep in mind, compounding is the biggest magic. We gotta let our portfolio the initial time, 5-10 years it needs before the compounding really starts to show up. Right? That's what it said, right? It's a famous saying, Warren Buffett made 99% of his net worth after, 55 years? After 55 years, because then it's just a compounding machine. So anyway, so I thought maybe I'll share some of these charts, which as an investor, I think we all should learn from these charts and imbibe these charts. I see a comment. There's a TTD and Shop are disappointing, but we'll keep. Sold Palantir last year. Okay. Yeah, we will talk about these companies today. Rajiv, India recently discovered a large lithium reserve in J&K. Cool. Yeah, I haven't been following up, and that's the reason I don't think I'm going to be a good commodity investor. That's one area where I don't have any, I would say, good understanding. All right, let's shall we jump into earnings? All warmed up for earnings? There are a lot of earnings that we have to go through it. Okay. All right, I know Ramesh mentioned sold Palantir last year. Anyone still holds Palantir? I do own Palantir in my portfolio. Disclosure. So Palantir, what do they do? So Palantir is a software company which has a few products. Way back we had done a deep dive on Palantir, so I'm not going to do full deep dive, but maybe quickly give you overview of these three products, what they call as Foundry, and Gotham and Apollo. Right? But the Gotham was the first one which they started, and then moved to Foundry. So Foundry is nothing but that operating system. They call it an operating system, but basically consider it as a platform that synthesizes data from multiple, all your departments in your company, and then try to find out the relationships between them using AI and all that, and give you an overview of where the problems are and how to solve it. So that this is focused towards commercial clients, right? A lot more details are there into it in terms of how they build those models and all that. But Foundry is their product, which is focused towards commercial clients, including all analytics, workflow, and then they can integrate your ER. So for example, you have a HR system, that's great, but that doesn't talk with your, let's say, your supply chain system. That doesn't talk with your financial system. So what they do is build integration, get all of them together, and then try to find relationships between them, and be able to find out the issues before they happen and suggest the corrective measures. So that's a Foundry. But the product that probably most people know Palantir for is the product called Gotham, which is mostly for the government agencies, right? On improving, decisions for operators. Some people like it, some people don't like them, doing this, because this is the software that is used by a lot of, I would say, military agencies. US military uses it. A lot of other three-letter agencies in US, CIA, Pentagon, FBI's, ICE, they use it. So to, run and find out the threats and all that stuff. So third one is Apollo, which is more as a marketplace, because the models that they are building and want to enable We want to create a platform and enable other developers to build that. And also this becomes for a companies to how to deploy these in a more cost-effective manner, right? How to quickly get these models up and running is what the Apollo is for. So with that out, the basics out, let's talk about Palantir. So Palantir, I think in January also I spoke about, I'm bullish. It has got a moat because there are not many companies who do it. Google refused to work with, US military and all that. They don't want to work with ICE, but Palantir was very focused on, we want to help with we want to help work with US and Western allies. So, but that I mentioned that I do have two things that I want to focus on Palantir is stock-based compensation, because that has been a challenge ever since the company had gone public, right? The other thing is commercial revenue. If the dollar is only coming from Gotham, only coming from a government agency, then the valuation will be like a government contractor, right? Then you will not be able to get the valuation like we get it for a software companies. And for many years, it's not a new company. This company has been around for almost 20 years. It's not a company that was founded like 5 years ago. It's been in existence for almost 2 decades. But most of the time wasn't in public. It came to public only in the last 2 years, but most of the revenue was from government segment. And then they started to diversify into commercial segment. That's where I got interested in it. And we do want to watch the percentage of revenue coming from commercial, and stock-based compensation is the other thing that I want to watch in the results. But current tailwinds, hey, we know what's happening in Ukraine. And with all that little fear in the markets, you don't know which dictator will suddenly wake up on one fine day and say, hey, I want to go and attack this, other country, or want to annex this portion. So there's a little fear mongering happening around the world. And number two is it's strength in AI. And right now the AI has, I would say, caught everyone. Now this become a rage. But that's a lot of a hype. But Palantir is a company which is actually putting that AI to some use. Right? So results came out. We're going to look at all these things. But before, let's look at their Q4 highlights. GAAP net income of $31 million. And this is what surprised the market, that they actually were able to turn a profitable, and not just adjusted profitable, not just EBITDA, not just non-GAAP, but it actually GAAP profitable. And this was the first ever quarter in their history where they actually made money. And if you listen to Alex Karp, who is a CEO, Dr. Alex Karp, who is the CEO of this company, he says one of the questions that we always get asked is, if your software is so good, why you're not profitable? Yeah, they were not profitable. And then say, hey, we never focused then, but now we are starting to focus on our profitability. And they were able to eke out. I would say it's a symbolic that they are profitable, because hey, you got a 1 cent per share as a profitability, but it's more symbolic that, hey, they have now figured out a way to, move into profitability. And in current market, if you go back, look at, analyze a lot of companies now, all of them are starting to talk about adjusted profitability, GAAP profitability, and people are not putting more focus on huge growth, right? Times have changed. So, but even with that profitability, they were able to, overall revenue was up 18%. But I want to look at his commercial revenue also grew 215 million, 11%. Government is still big, growing 23% year over year. What else? Financial overall, let's look at overall full year. Total revenue is up 24%. Right? Whereas, we look at the growth from so-called the big tech companies, the established software companies, all of them have been showing anemic growth. But Amazon 7%, Microsoft what 2% growth. Right? But Palantir still were able to put up numbers which are, I would say, pretty respectable numbers given the market that we're seeing currently. Total revenue grew 24%. Better is the commercial revenue. It grew faster than the total revenue. Means now this is becoming bigger segment. Of course, it has still has to catch up with the government one, but it is slowly and steadily this is becoming a bigger segment. So this is what I like, because I do want to know in terms of, are they making inroads into the commercial side of the house or not? Because if you're just selling to government, you don't have much pricing power, and then there's a lot of other risk when you're bigger buyer, when you have only few bigger buyers. So good to see that the diversification into the commercial is actually paying off. Loss from operation, adjusted income, cash from operations is 294. What I also like is free cash flow. It is adjusted. So we're going to go back and see, okay, what is that adjusted means? Revenue outlook is between 2.18 billion to 2.2 billion, which is 14 to 17%. Not a super high growth companies, not super high growth, like we're not looking at 30, 40%. So it's a steady one. Right? What I liked, now going back to the couple of things which I mentioned earlier that I do want to see is what have they done on stock-based compensation, because that's always been the biggest I would say bearish thesis around this is, guys, you are just diluting shareholders. So in this one, eventually we saw that on 2022, they actually reduced stock-based compensation by 22%. So which is a very shareholder-friendly move, that they're reducing the overall, the stock. So that, and the market, handsomely rewarded it. I think it was up 20, it closed after the earnings. I think it closed that day up 21%, and then it further went up. I think a lot more because of whatever the tailwinds or the hype around AI. But in our respect, I think now market is now able to realize that, hey, this could actually, company has been able to turn profit, able to control the stock-based compensation. These were a couple of, and able to diversify their sources of revenue. So let's quickly, which is from moving from just being dependent on commercials, also move towards Palantir. Move towards, rather than be dependent only on government, also diversify into commercial segment. So we've gone through these numbers. Oh, come on. I'll skip this. I just want to, of course, then they also talked about new products that they have released, process mining, scheduling, a marketplace developer suite. I'll skip that. Few things that I do want to share is, yes. So overall commercial revenue growth is up 67% year over year. Right? Even though right now the government is still much bigger part of their revenue, but the commercial is growing at much faster pace. Right? Net dollar retention, 115%. Not the best one. I mean, I have seen crazy numbers of like 170%, but anywhere for a software company, for a SaaS kind of a company, anything between 105 to 125 is a very respectable and decent dollar retention ratio. This is cool. Overall total customer count grew 55%. At the time when we are seeing a lot of customer cutting back on their expenses, what we hear from other software companies is companies are, either delaying the decisions or cutting on their expenses, but their overall customer count grew 55% year over year. We added 30 net new customers just in Q4. Commercial customer count, again, chugging along nicely. Overall deal closed in 22 was up 61%. It's sort of like, this is another one which I want to share, is 55 deals of at least 1 million, 11 of which are at least 5 million, and 5 of them are at least 10 million. So they do have a bigger deal size. However, the average deal size has actually come down as compared to last year. But I'm not going to ding company on that, because when it comes to a commercial, deals, governments can sign 100 million worth of deals, right? Commercial, when you go to start to move towards the commercial segment, your average, the deal sizes will start to go down, right? $1 million, $2 million. So what could happen is you have a more number of customers, but the overall deal, the average deal size will go down. But that's okay. Gross margin 80%, nice gross margin, and ended 2022 with $2.6 billion in their cash and cash equivalents. So balance sheet perspective, I would say this is well capitalized and no debt. I don't know if they did announce a buyback, probably not. Yeah. So these is a quick one on Palantir. Again, I do hold, when I talked about this, I also added more to my position, and I know the current, it's 50%, 60% growth in 2 weeks is not sustainable, but I'm in no rush to make quick money on this one. So I'll hold it and continue to sell options to reduce the cost basis. But maybe, markets now start to realize that this company actually could be profitable. My only thesis is that it has a solution, especially, which probably other companies don't. So that's the more that it has. And now they're expanding their revenue mix. So that's on Palantir. Sam, you're so cool. Waiting for the last January presentation. Put in Palantir order $5 for 300 shares in IRA. Okay. Is it cheap or not? I mean, if you want to compare it with whatever in 2021, price to sales of approximately 10 looks ridiculously cheap, because we have seen price to sales of 40, 50 in 2021. But right now, the market is not rewarding so much. I think on a median basis, for a median basis, I think it's 6 or 8 is price to sales is what market is rewarding. But so it's not cheap, but I think it's expensive for a reason. Yeah, that's my thought on Palantir. I'll continue to hold in my portfolio. All right, any questions on Palantir before we move to the next one, which is Airbnb? All right, any other holders of Palantir? Yeah, I mean, some people like it, some people just hate this company because of its association with those government agencies. All right, cool. So, okay, no questions. Then let's move over to Airbnb. I don't think this company needs any introduction, but it surprised the markets and had a huge jump again on after the result announcement. So overall, let's see if there is more details to share from a shareholder letter. Okay. All right, you've been very generous, Sam. No, I don't need the gift certificate, but just show up every week here, and that will be my remuneration for if something has worked out for you. Yeah, no need to send gift certificates to me. But I appreciate the gesture. So thank you. If you do want to support this, make sure we show up here, and maybe once we get into in person, maybe you can buy me some beer. All right, let's talk about Palantir. Palantir revenue of 1.9 billion, again increased 24%. This is one of the best overall quarter ever. Net income, again, they are also now first full GAAP profitable year. Palantir also, Airbnb also able to exhibit GAAP profitability, and also generated overall on a yearly basis $3.4 billion of free cash flow, which is like, I could never imagine that Airbnb has sitting on almost $3.5 billion of free cash flow, which gives them a lot of optionality. So looking at key business metrics, gross booking value up 35% year over year. Again, that means people do want to travel, and this shouldn't be any surprise for any one of us. People do want to travel. They want to go and have a lot more experiences after whole pandemic. And remember, this is the company that almost died during the pandemic. I still recall, they also did a layoff during the pandemic, and they allowed the employees to hold on to the laptops, but they had to go and raise money at 10% rate of interest when the Fed funds rate was 0. But no one was willing to give any second chance. So when they had to raise money to survive through the whole pandemic, it was a huge, expensive proposition for them. So I think some part of a time, Airbnb should become a kind of a turnaround case study of how a company moved from from the brink of bankruptcy or from brink of extinction, that they had to raise. I think they raised $2 billion. Again, it's been almost 2 years, more than 2.5 years ago when we reviewed that. But they had to raise a couple of $1 billion at very expensive rates just to survive. And now from that position to the position where you have $3.4 billion of free cash flow, I think the credit goes to the management. Right? Again, all the metrics look good. 35% year over year gross booking value, nights and experience booked 31% year over year. And I think market just liked it. So few things I do want to share from highlights is GAAP profitable full year. And it was the most profitable Q4 ever for them. One thing which, if you listen to the earnings call, Brian Chesky will come and talk about taking a dig at some of the other big companies, is since 2019, employee count is down 5%, revenue is up 75%. Whereas for the other companies, it's the story is reverse, right? Google's and the Metas and not Apple, but Amazons of the world, they have increased their employee count by, in some cases, like double, more than double. And now we are seeing the impact of those is a lot of layoffs coming from them. But the revenue did not increase correspondingly. So Brian, he minces no word, taking a dig saying, our employee count is actually down and the revenue is up 75% since 2019. Overall, $10 billion of cash and securities on balance sheet. So pretty well capitalized. We talked about this, and now they're also talking about doing a share buyback. Other important metrics is nights from the long-term stays, which is 28 nights or longer, has remained stable from a year ago. And that is actually 21% of the overall nights booked. So almost 1/5 of the bookings is for long-term stays, right? Which gives a lot more predictability. Ended 2022 with 6.6 million active listings. So that's what this is called as the biggest hotel chain that doesn't even own any hotel, right? 6.6 million properties, if you may call it. And other interesting thing which I saw in the balance sheet is this. If you look at an interest income, I think I have a balance sheet. Hold on. No, so maybe below we'll have a balance sheet. Where gross booking, there we go. All right. And which is what was interesting to see, that they have a interest income of $103 million for this year. So this is like a free money to them. This is like the insurance companies, they generate float. This is how the Airbnb now has that float, because when you and I, we book on Airbnb, we immediately pay to Airbnb, but they don't pay to the host until the transaction or your travel is complete. So Airbnb gets to retain that amount for free. And that's where now, given the increase in the general interest rates in the markets in 2022, they were able to get, almost not 106, which was 100 and whatever, $4 million for the year of, interest income, which is nice to have for almost no risk and no work. Another company which does this, and completely unrelated, but I do want to share the reference, is go and try to find an article, is Starbucks is a big bank. And again, that comes from the fact that a lot of those Starbucks cards, and I also do that, you load $25, $50 on your Starbucks card. That is a free money available with Starbucks. And I think overall they have a couple of $1 billion or something like that, a few $1 billion of deposit, these customer money for free. And that's, if Starbucks become a bank, it will become a, it will be bigger than many of the regional banks that we have in US. Say with the case like Airbnb is enjoying that float income of $100+ million. Also, they repurchased $1.5 billion worth of shares. Repurchase is fine, but what we are more interested is, like, a lot of companies will repurchase it, but then they will also issue a lot more stocks to the employees, and eventually the overall share count goes higher. But at least in this one, they're trying hard to keep the share count consistent. So any of those shares that they had issued to their employees, they kind of negated the impact of those share dilution by repurchasing their shares. So overall, I think still a great, it's still a good quarter, great quarter for them. Again, this is one company which does pass my snap test, which is, if it disappears, will we feel a pinch? Sure, because no one else does it at the scale at which Airbnb is able to do it. I know there are others as well, Verbo, which is owned by, I think, Expedia. Plus, there are others, smaller players in the same segment, but none of them does it at the scale at which Airbnb is doing. So, markets rewarded the shareholders handsomely, and I'm pleased to be a shareholder of this company. So sometimes, and again, not an advice, but we really don't have to look too far to find out which company I should invest in. I invest, if you recall that incident, I bought Airbnb when, as a family, we were planning to travel to the northern part of California, and we wanted to stay in an Airbnb. And I was like, number one, there were very few properties available, and those that are available were exorbitantly priced. So I was kind of priced out. I'm like, no, I can't spend so much money. But then my question was, guys, if this company is able to command so much premium, maybe I should look deeper and then start building some positions on it. And that was my trigger to, okay, let me look at Airbnb and start to see if I want to add it in my portfolio. But that was a trigger point, right? You don't have to go too far away. The fact that we had to cancel that holiday because it's so super expensive to stay in Airbnb at that point of a time, okay, this company had some pricing power. I know there are some backlashes around their cleaning fee and all that stuff, but I guess things will sort out. I see Sam says bad experience. I mean, I have had, we have stayed in Airbnb multiple times, like before pandemic, have stayed multiple times. I think it was only in one stay where we had a bad experience, but other was a pretty good experience. So I would still like to stay in Airbnb if I'm not priced out of it. Right? Our preference is to stay in Airbnb. Yeah. All right, that's on Airbnb. Let's talk about another one, which is Shopify. So a quick overview. Shopify is a company, it's a Canadian company that helps merchants. I started looking at this company for like 4 years ago. This is like where many of the big brands will go if they want to avoid Amazon, right? So of course, Amazon is the biggest e-commerce player, but then we also know that Amazon, if you become too big, Amazon will copy you. You don't control your own experience as a brand. Don't have much. You don't have. I wouldn't say don't control, but you don't have a lot of control on your brand experience if you're on Amazon. Shopify cater to needs of those merchants. Cater to the needs of small and medium business segments, and also if you for the companies who don't want to use Amazon. So it have a two type of solutions. One is merchant solutions, other is subscription solutions. That's their two bigger product categories. Subscription. So merchant solutions are which will allow merchants to build a storefront, accept payments, fulfillment network, logistics, your credits, basically allowing merchant to run their business. And subscription is depending on what kind of merchant you are. There are different levels of subscription which allow you to host it. These are the monthly recurring revenues. Merchant solutions are all based on your usage, how much of money is being spent or how much sales you're making. Subscription is your subscription fee. So those are the two big ones. Now with that out, let's jump into their earnings. So gross merchandise volume, which is the total amount of total value of the goods sold on Shopify platform, was up 13% year over year, which is outpacing US retail growth of 6%. So retail grew only 6%, but Shopify grew 13% on their e-commerce, which means they are they're growing faster than the overall market. Factors that drove this Q4 is strong spending throughout the holiday season and Black Fridays and Cyber Monday record-setting sale during this. Now, attach rate is what will convert these GMV to the revenue, right? So GMV is how much is the total amount, the value of total goods sold. Let's say it's $100 of something that is being sold on the platform, then the GMV is 100. But then $100 doesn't come to Shopify. What Shopify gets is the attach rate. And now attach rate, I do want to see that attach rate going higher because it's almost consistent around, between 2.5% to 3%. Right? But it continues to grow over time, but it has grown slowly than what I would want to see, but not bad, right? So this is how your attach rate, it turns into revenue. So even though GMV was whatever $60 billion, the revenue of the company, revenue for Shopify in Q4 is $1.7 billion, which is up 26%. as compared to Q4. So this means, at least in Q4, they were able to extract better attach rates. Because remember, GMV grew 13%, but your revenue grew 26%, which means for the same amount of a goods sold, you were able to get more revenue, means your attach rate in Q4 was higher as compared to your last year, which is the thing that I would want to see as an investor. Now, how that is segmented between these two bigger solutions, merchant solutions growing 30% year over year, subscription is growing 40%, which is what we want to see. Payments revenue, again, overall, Shopify also, they use this Stripe, I guess, on the back end and allow to do the whole payment processing. And if you look at the bigger stories that we have seen, not the Amazon. I don't know, Amazon hasn't really worked out when it comes to the payments. But if you look at the Mercado Libre and in terms of what they have done with their payment has become much bigger part of their overall business when it comes to the e-commerce. So Shopify GMV overall number, the dollar value of the payments that was processed is 23%, and the penetration is 56%, means of the overall orders, how many people are using Shopify payment network. Gross profit is up 15%, which is a little not concern, but it'll give you an idea of that. If revenue is up 24%, why is gross profit up only 15%? It means your expenses have gone higher, right? And your adjusting operating income was actually down. So something had happened on the expense side of the house, even though the revenue is up, but their expenses or the impairment charges, they had to take on their P&L statement that caused their gross profit margin was down, their operating margins were down, their adjusted net margins were down. So good story on the revenue side, not so good on the margin side of the house. So they do talk about in terms of they had to take a real estate impairment charge. Additional headcount came in through the acquisition of Deliveroo, and they also had a new compensation system that was implemented. So we do want to watch out if it is like one time or is the margin will be tight going forward. Something that we need to keep an eye on. Now, overall, from a cash flow perspective, there are free cash flow of 90 million, not really huge, but balance sheet, they have almost $5 billion on their balance sheet. So now the markets didn't really like it, because when your revenue is up 24%, but your profits are actually not, that up, means you're actually not having operational leverage. So rather than it's a deleverage, which came through that higher expense number. So we'll have to, this is something that we want to watch out for, but I'm not losing my sleep on just this, one quarter of what happened in this particular quarter. A lot of products that they added and shipped, they added Shopify Audiences, collabs, this is point of sale, tap to pay. They launched Shopify Pro for the international, for the international merchants. And again, they added more solution to their hydrogen and oxygen platform. Some, fancy names for their platforms. So again, more back office merchant solutions for more countries, capital, where they actually give out loans to merchants. Shopify Shipping, name suggests it's a fulfillment network. Payments is payments. So from their payment perspective, it's been growing nicely. So for example, 100 million plus buyers opted to pay through Shopify, which is what, 56% penetration is what they mentioned, right? Overall, 5.6 billion revenue for the full year, not for the quarter, for the full year, 5.6 billion, just 10% is their e-commerce I would say penetration, their market share, not the overall, but of the US e-commerce, they are only 10%. So still a lot more growth they could have. And we know that the biggest gorilla is, the bigger ones are Amazon and the Walmarts of the world. But still, Shopify has a room to grow if they do all the right things. Then they also launched Shop Promise, which is like Prime, like Amazon Prime like service. Okay. They also want to simplify the logistics, and this is where their expenses that they came in by acquisition or Deliveroo. This is why I'm not really big concerned a lot from that. Remember, going back to this 2013 or 2014, somewhere at that point of time, maybe between 2013 and 2015, I guess. Amazon had decided that they want to go into now investment mode to build out their logistics network to do next day shipping, right? So Amazon used to have, I think the earliest was 2-day shipping, but then they wanted to offer next day shipping, but that means they'll have to spend a few years just in investment mode in investing the logistics capability. Yeah, market didn't like it, stock got punished. Well, that's fine. You have to invest to grow in future. So today, their Deliveroo acquisition and all that's costing them on the margin side. I'm okay with that because this will make them more competitive going in future, right? So the run rate of Shopify fulfillment network, right? So that's the bigger expense, and that they also expect this to be a headwind to the gross margin and significant expense contributor in 2023. So this probably will continue. This probably will level off after a few years. But I'm okay as long as the money is being spent to build the Shopify fulfillment network. Right? So overall summary, current quarter, they beat on top line, bottom line. Quarter performance was good. If you just watch the stock price, you wouldn't know that because the stock was down, 15% or something like that. Do I have a chart? No. So let's go back to shop. If we suddenly woke up, next day morning and see, okay, how did Shopify do? Yeah, it closed that day down 16% after earnings. Yeah, but there was nothing bad in the current quarter. I think the current quarter was good. But remember, where we saw a big jump in the Shopify, where was that? I think this was the time when we saw a big jump in Shopify because Shopify had introduced a new pricing. They have never increased their pricing last 12 years. So they added, basically increased the pricing of their subscription services. So market rewarded it. Probably market was expecting that the impact of those price increase will start to show up in the results. Not so soon. That didn't happen, right? And of course, we looked at the expenses were higher, so margins were under pressure, right? Gross down, operating down, net down. So management did talk about and address the question of when those impact of those increase in the shop subscription prices will start to show up, but that will start to show up only from April onwards for the existing customers. So it didn't, market was expecting maybe for it to show up sooner, and they punish the stock. So anyway, I'm not bothered right now about Shopify much. I know it is still, from a valuation perspective, I think it is still expensive. Or just say that. Let's see what's their valuation is. Shopify. Yeah, they're still at almost 11 price to sales. right? So which is big. So they need to continue, have to show these high teens or maybe mid 30% growth to maintain this valuation. But I guess I would rather want to see growth and not worry too much about margin. If market has to worry in a short term, so be it. It goes down, we'll take our opportunity to add to portfolio. Right. Other interesting thing is offline GMV grew 25%, which means this is for their Shopify Pay, which is great. That things that have been sold not on Shopify but using Shopify payment, that grew 25%. But right now this is a very small part, so it doesn't really impact the overall business. So that's on Shopify. Any questions you have on Shopify? Any concerns, or what else did you see in Shopify? Or if you hold Shopify? All right, so that's on Shopify. Moving to the next is Doximity. Right. Does anyone know about Doximity? Any shareholders of Doximity? Yes, physicians. Yes. So doctor, again, I'll do a quick review of what the company is, and then we'll jump into the earnings. Or maybe we'll do both. So let's look at what the company is. Yes, I had reviewed this when it went for IPO. So we reviewed its S1. I guess it's been a few monthly moons already. And this was the social media company, which was actually profitable when it went to IPO. And when I say profitable, not the adjusted profitable, but it was actually GAAP profitable when it went IPO, and had a very, I would say, very mediocre valuation, which I was like scratching our head around. How come? Because this company was under the radar. And that's what when it went IPO, it was a pretty decent and nice valuation. Right. Again, this is very focused. So Doximity is a company that provides Facebook plus LinkedIn plus Twitter. Okay, no, I can use this, right? They provide LinkedIn plus Google plus DocuSign plus chat plus Zoom for physicians. If you're not from a doctor family or don't know, your circle is not of doctors, you would have never heard about this company. But 80% of US physicians are on this platform, right? And their focus is to automate a lot of the stuff that doctors have to do, hospitals have to. They're not big on bigger hospitals, but let's say smaller care centers, right? And what they want to focus on is increasing the productivity of doctors and those health clinics or health facilities. And so it's a kind of a social platform wherein if you are searching for you can connect with and network with other doctors, just like you do on LinkedIn. You have a news feed which talks about a lot of advancements happening on the medical science. And then, of course, you can, do a telehealth with your patients. You can share your documentation, share your reports confidentially with your patient. And again, this being the healthcare, it takes time to build all this under, all HIPAA regulations, make sure you're all compliant with that. But this company is focused very much on physician network, helping them improve their productivity, right? How they make money is also, and if I'm a pharmaceutical company and, I could advertise on their platform, right, to educate on latest news and the treatments. You could do hiring, right? Of course, we talked about telehealth. These are the marketing solutions wherein, you could have, let's say IQVIA, they reported 11:1 rate, return on investment using their marketing solutions, so on and so forth. So this is how they start with one module. They're complex pharmaceutical manufacturer who wants to advertise, they'll start with one, and health systems, they'll start with one. Maybe let's use them for communication, right? Then maybe expand it to telehealth, right? And then maybe add more modules or expand it to more physicians. But that's how they generally work on land and expand. And this is pretty standard model for any software company which has got multiple modules, right? So overall, okay, so let's look at the metrics. Yeah, overall, that's what the Doximity is looking at their, and again, they have some weird financial year. So this is Q3 2023, right? Whereas the rest of the companies was Q4 2022. Their quarter is Q3 2023. We're seeing over the last 2 years, 30% CAGR in terms of number of customers with more than 100K revenue. Like it, net revenue retention down to 119%. You may hate, hey, what happened between last year and this one, right? Of course, now a lot of customer could have come because they wanted to utilize, let's say, telehealth solutions, right? Now there are a lot more in-person happening. So, or if in 2023, not the customers, but a lot of customers would have signed up for telehealth as an additional module. This quarter, maybe not many of them have expanded with those additional modules, but still to see, 119% growth. Like I said, with respect to which one we were reviewing, when I said around 115%, I think Palantir, 115% is a respectable one, right? From a revenue perspective, overall revenue is $418 million, growing at a nice pace of 50% CAGR, which is great. It is founder-led, almost 973 employees, and 30% are in R&D. So that's overall on Doximity. Let's look at their numbers. So revenue increased 18% year over year, for the third quarter. So which was great because they were able to increase their revenue while the other social media companies are reporting decrease, right? Facebook is the bellwether company for your social media, had a decrease in revenue. And whereas they are able to increase it at 18% year over year. What I didn't like was net income actually declined. Right? So even though revenue had increased, net income had declined. When it's a net income, that is actually GAAP net income, right? So one good thing is that they are profitable, almost 30% net income margin, which is great, but it was down from 57%. Now, non-GAAP also declined. So I'm like, okay, what happened? Well, revenue increased, but why don't we see the increase of the impact of increase in revenue on the bottom line? So it means somewhere they had high expenses. So digging further down, I was looking at where did they did they have a huge expenses, operating expenses? I didn't see too much, but what I did notice was the difference between the provisions for your income taxes, right? So this is what we see, this accounting profit, net profit is an accounting profit, has not much to do with the operations. Yeah, a little bit of sales and marketing increase from 25 million to 33 million. R&D increase from 16 to 20 million. But that, I think, it's not a big difference. Then the big difference which I saw was provision for income taxes. That's like almost $27 million big difference. right? So, which I'm okay with it. That's more to do in terms of you retaining money for paying earlier. Probably they paid more for prepaid income tax. Now they have to actually provision for income tax. So then I was not too worried about it. Okay. What I did like is they have a free cash flow of 47.5 million, which is up almost 85%. Right. So it means I was just trying to look at what happened. So cash flow has increased, even though expenses have increased. So while I was trying to look at it, there was a lot of learning for me as an investor. I mean, that's why I love doing this session. It's the first time I saw these. I'm like, what the heck is happening? And then, you fill the gaps. Like I said, you to come and talk about it, then I need to, I want to know, okay, I want to learn what's happening in their financial statement. We look at a revenue up, but net margin down. Okay. It means expenses were high. Okay. But then expenses are high, but then you got a bigger free cash flow. Okay. It means your non-cash expenses would have gone higher. Then I was trying to look at, okay, what happened? Is it stock-based compensation? Because that's one is, will always ring a bell. Many of these companies will hide their expenses under SBC, and I don't like those. Palantir used to be the one. Or are they depreciation? Then I said, okay, let me figure out what's happening on the cash flow. And this is where I think the thing that we looked at, then I started looking at the cash flow, is the thing that we pointed out even on a P&L side is the same thing. It's more cash flow because of your income tax side. Stock-based compensation, yeah, increased by a bit, but the majority is from your deferred income tax perspective. Right? So you see the impact both on your profit and loss and on the cash flow statement. So free cash flow is higher because of that. So then I was okay. Not bad. Nothing operationally, it is still doing okay. Right. So that's on Doximity. I do own the shares. It's a very small percent. But this is a company it's a niche company, right? So it's not that it's gonna grow, can become as big as Amazon. It's just focused on physicians. But it was an interesting lesson as an investor, trying to peel through these conflicting, I would say, metrics or the numbers. And me not being an accountant, it's a fun. There's a new learning. I'm sure someone who's a CPA would say, oh, okay, come on. It's so easy to figure it out. For me, it takes some time. All right. But the reason I want to share is that we don't have to be an accountant to be an investor, or we don't have to be. I do hear people talking about that investing, is a loser's game for retail investors, because you can't beat Goldman Sachs on those folks. I don't subscribe to that. I think we are playing a different game than what hedge fund managers are playing. So yes, you can't beat Usain Bolt in 100-meter dash, but you can beat them on marathon, right? So play a different game. All right, so that was a Doximity. Next one is a Trade Desk. All right, any owners of Trade Desk? Again, I do own Trade Desk in my portfolio. So what is Trade Desk? Basically, Trade Desk provides a ad tech solution, advertising tech solution for companies to purchase ads, right? So there's on a demand side platform for if I want to buy ad. And again, most of these ad buying business online has become programmatic, and Trade Desk is the non-walled biggest player. Of course, there's a Google, but then Google is walled player, right? So Trade Desk is the biggest one when it comes to non-walled player. We have talked about Trade Desk as a business and as a company multiple times. When I think we went into the details of how the whole ed tech platform and the ed tech industry works. But there was a huge concern about Trade Desk when Apple had introduced and their privacy. Number two is when Google said that they don't want to, they want to phase out cookies stuff. So since then, over last 2 years, Trade Desk has been pioneering another system called Unified 2.0, Unified ID 2.0, which will still allow the advertisers to collect information, but not you will not, but it will still be not as previously invasive as with cookies, right? So they were the pioneer and started working with a lot of advertisers, a lot of advertising agencies to make this as a new standard for the ad tech platform, right? So from a overall revenue perspective, Q4 revenue grew 24% year over year. And we are talking about the times in 2022 when everyone is talking about recession, and first thing that companies cut in recession is advertising. That's the reason why Google has been down so much, because hey, in recessions, first thing that will get cut is advertising. And Facebook, Google, all the companies that were dependent only on advertising, not only on, but the majority revenue coming from advertising, are all impacted because of recession fears. And the Trade Desk is able to grow their revenues 24% year over year, and 24% quarter Q4 to Q4, and 32% for the full year. So they are doing something which Google's and the other companies that is dependent on advertising revenue were not. So clearly they are eating up someone else's lunch. And I think that's what market liked it. Other thing which market liked is they also want to repurchase. They got authorization to repurchase $700 million worth of its own shares. I'm not the biggest fan right now of the repurchase. I think they should continue to invest in the business. But yeah, as long as, if this reduces the share dilution, it's fine. But I would rather still want company to invest in the business and grow the business. So yeah, overall 491 million of revenue in fourth quarter. The performance was underscored by significant profitability and cash flow. Right now, everyone is start to focus on profitability because of the macroeconomic situations. Okay. So they are leveraging new identity tools, UID2. I think they also had a Disney use this. So overall, if you look at 400, let's look at the year ending. So 1.5, almost $1.6 billion overall revenue, $53 million net incomes. They are GAAP profitable. Customer retention remained over 95%. This is not the dollar-based retention, but this is how many customers they are still able to retain with Trade Desk. So yeah, there has been some churn, but they were able to retain 95% of their customers in the macroeconomic scenario where advertising is under huge pressure. Right? Continued collaboration in support for Unified ID 2.0. They were the first one to, to basically to promote this, and good to see that leading advertisers who ran campaign on Disney's UID2 powered reported 12 times more effective in reaching the target audience. Right? Now, I have not gone into the details of what this Unified ID 2.0 is. If someone is from the ad tech business, feel free to jump in. But I think for me, the fact that this is being adopted is good enough. When I have a lot more time, maybe I can find out what the heck is Unified ID 2.0. Right? Other new thing I saw was Galileo. This is to onboard and activate their first party data. So now when it comes to your advertising, you will see there are a couple of terms, right? First party data or third party data, right? So first party data is coming directly from the first part of customer interaction, right? Your CRM platform, right? Customer bought something, so that's your first party data. So looks like they launched a new product called Galileo. Don't have much details around it, but maybe we'll see in future how does this impact. Outlook is next quarter they're projecting at least 363 million, which is what I don't know what is the previous Q4. And so overall summary is that they're growing much faster than the overall market, because it looks like the online advertising market overall, it grew 8%, but whereas Trade Desk grew at 24%, which means they were able to grow 3 times more than the overall market grew. So they did eat someone's lunch, right? So they are taking some share from their competitors. So markets like that, the impact of slowdown advertising didn't show up in this company. And I think shares were up like 25% or 30% or whatever. They at some point of a time, if I really look at this, so it was like up, they closed almost 33% higher after the earnings report. Because this was like a surprisingly good result coming from a company which is dependent on advertising revenue. Whereas when it comes to the fears of recession, advertising gets hit the most, and that's what we have seen in Meta's and the Google's, right? Look at the Google's result, not at all impressive. Meta's result, actually they were down on revenue. So this was kind of a very positive, pleasant surprise. And maybe there's some short covering going on, who knows? But I'll take the 33% any day, right? I'm not complaining about that. All right, that's a Trade Desk. And not just Trade Desk. When Trade Desk went up, some of the other ad tech players, which I also hold in portfolio, I suddenly saw those going up 10%, 15%. I'm like, okay. Now, in the sympathy, now everyone thinks that the other companies also going to report similar results. Who knows? But yeah, markets sometimes are irrational. Many times are irrational. Right? We don't know what the real worth of the company is, and they just move up and down in sympathy with overall market, or what happened to the other company in the same segment. So that's a Trade Desk. Last company I think which I have is Roblox. Again, we had reviewed this as a company a while ago during the S1, but this is a company which, if you have anywhere, kids between, I would say, 7 to 13, then you would have heard this name. You can't escape it. But now I think they also expanded to beyond 13 to almost 16 to 18 years. But Roblox is a company that allow developers to build online games, especially targeted between, I think, between, I would say, 5 to 13 years of age. Now expanded also from, till 16 or 18 years of age. Again, so this was a huge success during the pandemic. What else you do? Kids were all at home, and not much to do. Parents have to work from home. They need something to keep kids busy. And if kids are, coming and happily playing on Roblox and not troubling their parents, go play, right? Win-win, both for the kid as well as for the parents. So they enjoyed a huge, had a huge upside during the whole COVID time. And then, of course, the comparative numbers will fall down. So we saw going forward, at some point of time, what, $141, and then the lowest is $21. Right? That's where the markets are behaving irrational, right? We don't know what the right worth it. But anyway, so they came out with their results, and revenue was up 2% year over year. Not that great, but what market liked was that bookings were up almost $900 million for a quarter, up 17% year over year, right? So the way the revenue and bookings, so the way Roblox makes money is, if I'm a kid and I'm playing games, I will buy. So like Fortnite had pioneered this business model, right? You play for free, but as you want to either advance to higher levels, or you want to have a better weapons, or you want an extra life in the game, then you can purchase it, right? So the currency in the Roblox world is called Robux, and as a gamer, I will go and buy the Robux, so that becomes the bookings, right? So over in this quarter, they had 17% higher Robux being sold on their platform. Now, when those Robux actually gets converted into revenue is when, if I'm playing a game and I want to buy that cool, I would say, dress, then I'll spend those Robux to buy that outfit, that can make me look like a super, the superheroes. I want that Iron Man suit. In that Iron Man suit, I need to spend some Robux to buy that Iron Man suit. When I spend that Robux, that becomes my revenue. So the fact that the bookings were up 17% could be a precursor to higher revenue down the line, right? So that's what market liked, that the bookings were up. Other thing which market liked were these two numbers. Average daily active users were up 19% year over year. Now, last year, when you're talking about this one, the comparative performance, when you look at always the previous year, right? So when you're in 2022, over here, your performance is being compared when the economy was shut down, schools were not open, and kids were spending a lot of time on Roblox. So when you do those comparison, the results were horrible, right? Now, comparatively, from a previous year to this year, 19% growth is decent. And total hours engaged were also 18% up year over year. So I think that's what market liked around Roblox. Overall, full year, 2.2 billion, again, up 16%, or year over year. Net cash was $369 million. They are not free cash flow yet, but I guess close to $60 million short of a free cash flow. Daily active users were up 23%. So these are the engagement scores, right? Daily active users and hours engaged. They were like 23, or let's say, I would say in high teens, right? 23 and 19% year over year. So that's what market liked it. And that's what CEO had to say, with 65 million daily active users in January. Now, that was for a Q4, which ended in December. And this is a little peek into what's happening in January. So in January, they had a 65 million daily active users. And we are driving towards our vision to reimagine the way people come together by enabling deeper form of expression, communication, immersion. Roblox is also a play on, can I use the word? I know nowadays it's a not a loud word, called metaverse. So this is also play in the kind of, in metaverse. So more engagement and more bookings. Market liked it. Think, okay, kids have gone back to school, but then the attractiveness of Roblox is still there. So the engagement is still high. And wow, the stock was up like closed up 27%. Right. And these are those one of few days, right? If you are out on your portfolio, if you have sold everything, you never know when this 20%, 30% up or down will come. It happens both ways, right? So fortunately, a lot of companies that I hold in my portfolio and had announced the results this week were all like, I mean, I hold all of these in my portfolio, had a positive surprise. Shopify did not have one. Well, that's okay. So that's Roblox. Even if you're not a gamer or if you don't have kids who play Roblox, now you know what Roblox is, what business it is in. All right, that finishes all the earnings that I wanted to go through today. And earnings, we are not done with it. And I was looking in the morning for the next week chart. I think some of those, I would say, a couple of bellwether companies, companies that will tell us how the overall market, overall sector could do. They're still to report earnings, like Coinbase should give an idea about how the crypto companies would be. What else we have? Nvidia. Oh, Nvidia have too much of a growth too soon. Again, my personal feeling is this whole AI, that's a lot more, I would say, fluff than the real stuff when it comes to the increase in the stock price. I think that's gone up too much too soon. So I'm not holding my breath. I mean, I'm a proud shareholder, but I'm not too, again, no one knows the future, but I'm a little cautious on many of these AI driven companies. Unity, gaming plus gaming plus kind of metaverse, but they are also moving into commercial segment, which is what I want to see on how their commercial segments will play out. Etsy, I don't own Etsy. I don't own Coinbase. I own Nvidia, Unity, but Etsy, a short seller report came out, which they may have to come and do some explanation around a lot of a counterfeit goods. So the short seller report from Muddy Waters, I think Carson Black is the guy's name. So they came out saying Etsy has become a shopping mall for counterfeit goods, right? Because they have sold all these keywords to the counterfeiters. So you go and search for Rolex, all you get are the counterfeit Rolex. You go and search for Nike, you got Nike shoes, but all are counterfeit shoes. So they're like, X is not doing what it should be doing. Why are they selling these keywords to these counterfeiters and all that stuff? So if you own Etsy shares, keep an eye on how do they respond to it. Teladoc, I hold in my portfolio. This is a position which is driven by huge. It was a pandemic benefit and now being driven in the ground. We'll see how they report. Alibaba, always a risk when you're talking about companies based out of China. Doesn't matter how great the company is, there is always the sovereign risk. By the way, there was another news of one of a big hedge fund, mutual fund CEO gone missing in China. And that fund is worth of $20 billion or something like that. I didn't go through the detail, but the headline was, if you are investing in China, it doesn't matter. You're an e-commerce platform, you're a tech platform, or you're a hedge fund, or you're a mutual fund, or you're a financial company. The sovereign risk is too great. So be cognizant of that. Block I own, Mercado Libre, will be looking forward to this. Big part of my portfolio. What else? I guess that's it. What I am interested in for next week. Cool. So that was all around earnings this week and the next. Now let's talk about another topic around options. It's been some time since I talked about some option strategies, and I think our audience makes changes. So I thought maybe I'll go back and cover some of those option strategies. If it is a repetition for you, feel free to drop. We're almost on the 2-hour timeline. Anyway, it's just 10 minutes remain. But first of all, let me know, should we talk about it? I do want to talk about covered calls and then some other variations of option strategies that at least I've been using it, and things that you could use if you want to stay active in market. We don't know where the markets will go. So how do we safeguard ourselves and reduce our risk in the market? All right, so I got one yes and no no's. So it means the yes wins 1-0. All right, so let's jump on to some of the covered strategies. The most common is the covered call. This is probably if you're just a beginner beginner into the world of options, the first thing you will hear, or the second, depending on is the cash secured put or the covered call. But I think generally the first one you'll hear is, hey, you've been long buy and hold investor, or the stocks that you hold don't earn any yield. So what do? Right? So the one is, you talk about a covered call. So covered call is nothing but you hold 100 shares or more in your portfolio, and then you sell out of the money call. So let's create that over here. Okay, so AMD, say, all right, I have AMD in my portfolio. So if I just hold AMD, this is what my profit and loss diagram looks like. AMD goes higher. So if you look at it, this is your profit zone. This is my neutral line. This is profit zone. This is loss zone on P&L diagram. AMD goes higher, I make money 1:1. AMD goes lower, my portfolio, if this is the only stock I hold, loses money 1:1. Right now, I am bullish on AMD, but I'm a little nervous. So some people say that you should sell calls when you're bearish. No, if I'm bearish about the company, I would rather sell the stock. Right? I'm not bearish about AMD, but I'm a little nervous about it. I'm long-term bullish on AMD, so I'm nervous about it. I want to reduce my risk. So, or, hey, I want to collect some, generate some income out of the stocks that I hold in my portfolio. Right? I spent a lot of time in 2022 where the markets were down, so I gained a lot more long positions in my portfolio. And hey, I want to generate some regular income out of it. So one way is to go and do a covered call, right? So if you do a covered call, that means come onto the call side and sell an out of the money call. So when you're looking at out of the money, means you come in the call side. When I say out of the money call, means the call strike price is higher than the current stock price. So current stock is 78, let's say around 80, that becomes at the money. I come out. Some people want to go via the dollar amount. I go via the delta. And again, if you want to understand the difference and of what the delta, etc., is, I think one of those bootcamp videos on Option Gig website, we do talk about the details of what those deltas, etc., are. Again, that's free for anyone to watch. There's a series of 14 videos talking about the basics all the way to managing portfolio using options. So I think this is the first or the second episode of the boot camp. Oh, those were the time when I had more time. We did some boot camps. Sorry, too much work. So no more boot camps. All right. Yeah. So you can come and maybe sell a call at, let's say, at a strike price of 90. So when I sell a call at a strike price of 90, means you are giving someone else a right to get the stock from you at $90 for next 27 days, or right, for next 27 days. That means that will happen generally if the stock is more than 90. So at a 90 on expiration date, which is March 17, if the stock is above 90, the stock will be sold. You will no longer hold the stock, right? But that means if that's the case, you actually gained all the way from here, 78. This is where the 90 is. You are giving yourself a room of $12. Means you'll make $12 plus 74 cents that you have already gotten when you sold this premium, right? So if the stock doesn't hit 90 or doesn't expire at $90 on March 17, this is yours to keep. And this is almost 1% of your stock price. Right? So worst come worst, you want to hold the stock in your portfolio because you like the stock. You are able to generate at worst 1% income by holding the stock, by selling this covered call. And you're picking the strike price 90 because, you can pick up whatever strike price you want to. But we picked up a strike price 90 because I think I'll be okay. If I'm okay to sell the stock, if it goes up $12. So $12 means almost 17%. Right? If today I ask you if you buy a stock today and if it goes up 17 plus you add this 1%, 18%, you get an 18% upside for next 27 days, you'll be pretty happy about it. Won't you? Right? It's a pretty decent deal to get 18% upside in 27 days. So this is, and if that doesn't happen, you anyway got 1% by selling this premium right out of the gate. So, and generally what happens is, it doesn't hit 90, you still retain your shares and you got 1% by selling this call. Then you rinse and repeat. Right? Look at, then you go back to your next month, you now are in March, then you go back and maybe sell April covered call. So rinse and repeat month after month. There will be times when the AMD may go above 90 and then you might feel, oh, did I, sold it cheaper? Or did I, lose on a huge upside gain? So, and I know a lot of investors in 2020 and 2021 had gone through that phase. And suddenly the covered call strategy, was not a loved strategy because, gosh, I lost on all the upside. Right? But over a longer period of a time, at least for me, it has worked out. So there are variations of it that you could use. Right. Let me talk about one variation, which is what I call it as a covered call spread. Right. Say, right now you look at from 78 to 90, you feel pretty good about it, making 18%. If the stock goes higher, stock is lower, you are a long-term holder of that stock. But imagine if the stock ends up at 110, how would you feel then? Or stock ends up at 120 because Nvidia wants to acquire AMD. Things could happen. Things have happened. Your acquisition price, they may be willing to pay 50% higher price for this stock. Right? How would you feel then? If that point of a time you feel, oh gosh, I think I lost my shares. The thing that I worked out better for me is instead of doing covered call, I do a covered call spread. That means instead of selling just a call, I sell a call spread. Now, when it call spread means you sell a call and then you also sold a call at 90, then you also buy a call further down, right? So let's say I buy a call at 17 cents. Of course, I have to sacrifice something. So instead of making 1%, instead of making 74 cents, I'm going to make, let's say, around 60 cents at 59, rounded off to 60 cents. So I'm not really making 1%, but let's say 0.8%, right? 80 basis points rather than 100 basis points. But then this keeps me in the game to avoid a situation wherein NVIDIA comes and say, oh gosh, we're going to buy this company at 120 bucks. I'm not, I'm not out of it. I'm not, I still get to enjoy the further upside, anything beyond 100. So all I don't make is this 1,000 bucks, right? So if I'm sitting here at 78, and if NVIDIA got sold for 120, yeah, I still get to enjoy this upside. Right? So that is, again, I don't know, there is not any, if you go and look at the option books, you won't file this name, but so I created my own name. I call it covered call spread, so that you don't have a seller remorse, right? If crazy situations like we have seen in a meme stock that came in, or the situations like 2021 come along, you won't have a seller remorse that you sold it too early, or your shares were taken away from you too early, right? Sitting today, 18% in 27 days sounds great, but if you had an opportunity to make 50%, then you ended up making 18% sounds horrible, right? So from that perspective, I focus on doing covered call spread, especially if there are individual companies or on the companies where I think, oh gosh, those could become acquisition target or have been beaten down. Like most of my tech growth companies, either I follow this or I follow another strategy, which is I'm gonna talk now. Is, again, there is no scientific name for it, so we're gonna create our own name, call partial covered call. Means I'll sell if I own 200 shares of AMD, right? I will sell only one covered call. That I'll sell a covered calls only on the partial amount of the long shares that I hold. And some of these things, you could do very well in stocks which are of a smaller denominations. If you have, 15 bucks, 20 bucks stock, and if you have got 200 or 300 of those, maybe sell one covered call, right? So these are the two strategies that I use to not have a seller remorse in case the stock explodes to the upside. Again, we can never predict, right? And that's a question when, that's a thing which happens when you're dealing with individual stocks. Because of corporate actions, things could, and no one knows about those corporate actions. It is not predictable. So things could explode to the upside. And if you have that seller remorse, maybe look at doing a partial covered call or covered call spread, right? So that you are still in the game. You're not sold out cheaply. Okay. Now, the third one, which I want to talk about, is you like the stock and you like it so much that you won't mind owning more of it if it goes down, right? Hey, I like AMD. I own it. My current cost base is 78. And I'll be willing to sell it if it goes to, let's say, 90, which is, we talked about, it's 18% return on investment. And I'll be willing to buy more if it is down like to 65. So in this case, this is basically you sell a put at 65 because, you know, if the stock goes and stays below 65 at expiration, you'll end up owning it at 65, which is a price point that you want to own. And then you'll be okay to sell it at 90 if it goes there. Then you basically end up selling a strangle. Strangle is nothing but selling a call and selling a put, both out of money, right? Both out of money. But what it does to you is your income is increased. And now you have collected $22. So $22 is almost or 1.7%, whatever the math could be, you know, more than 1.5% for what, 27 days? So 1.5% for a month is not bad. I mean, if a stock, and you got a lot more room, so stock has to be either above 90 for it to be called away, or below 65 for you to buy it. And the stock stays between these, you made your 1.5% and still retain the stock. Repeat it 10 times, you'll get a 15%, right? And you still hold the stock. And this is what when I talk about cost basis reduction is, when you focused on doing this year, keep doing it year over year and reduce the cost basis, right? If stock is just being sideways, people talk about, oh, market is going to be sideways. There's nothing in the market. I mean, I love sideways markets. It's the best when the market is sideways because we can reduce the cost of ownership like 10%, 15% year over year. And in like 6-7 years, you own stock free and clear. And if stock gives dividend, that's even better, right? You have your own dividend that you generated by selling this premium, and then the stock is giving a dividend, like a dividend on steroids. So this is like your premium on steroids. Now, if the stock, let's add back the stock here. Let's go back to, I'm doing one contract. So let's make it only 100, not 200. So this is the situation. This is what the situation would be. And this is what we say, right? Buy low and sell high. And I'm willing to buy at 65 and willing to sell at 90. And this is nothing but called as covered strangle, right? So basically the strangle, but it is covered on the call side by the stock that I own in my portfolio. If you don't own the stock in your portfolio, then it becomes a naked strangle. And I won't advise anyone who is new to options to do this, because what if AMD got bought over by NVIDIA? You're caught naked, unintended, on the call side and end up losing tons of money, right? So do a covered one. So this is what the second one is, covered strangle. Sell your out of money call and out of money put. Okay. All right. So these are the two. Now I'll talk about the third one also, but let me see some questions. Please review when your covered call keeps going up and can't catch it even by rolling as started in puts to keep up. Today lost my Netflix shares. Right. So I think kind of a covered in that if you have a seller bourse, like I have a melee, but I'm selling call spread on melee. Again, I don't own 100 of melee, so anyway, I don't want to do that. But I do have, like I have Airbnb, I have 100 shares on Airbnb, more than 100, so I'll sell call spread. just to avoid a situation wherein I want to hold the stocks for long term, don't want to get sold out cheaply, and hence instead of doing a call, I might as well do, $50 wide call spread or $25 wide call spread or things like that. That is one way. Of course, the other is rolling, that's again, little more deeper of when you're trying to manage your options. If stock goes higher, roll up your put, collect more premium also. But at least today, I just want to focus on the covered one and not even talk about rolling. So assuming that you won't have a seller remorse, if you have remorse, maybe convert it into call spread. Right? Rolling gets a little more, I would say, more management. So those are so we talked about covered call spread, partially covered call, so, or I would say covered call on partial shares, and then covered strangle. Right. So 4. Let's talk about another one, which again we've been doing during these uncertain times, is slight variation of this, slight variation of covered call. I don't know what to call it, and that's why I mentioned I don't know what to call it. You guys can suggest me a name, which is instead of just selling a strangle, because I'm a little bit nervous about market. Market go down way lot. Who knows that let's say AMD could go bankrupt tomorrow, and I don't want to own a lot more stock, right? Or AMD could just, right now I'm holding, let's say, AI stocks. Oh, AMD looking great, but maybe after the AI has fizzled out, it probably go down by a lot. So I don't want to expose myself to an unlimited, to the maximum risk on the downside. So the other thing is sell a call, collect a premium, and instead of sell a put spread, right? You sacrifice a little bit of a premium, but then it also, what it does is make sure if the bottom falls out of AMD, your risk in this trade is contained. You're not adding any more additional risk than what you already have from your stock. Or let me say, then you're not adding any more unlimited additional risk. There is risk that we are adding, but that is controlled only to a maximum $1,000. If the stock goes down to $20, just by doing this option trade, you have not added too much of a risk. And in the situations wherein I am, and this is like, I have a lot more trades in this one wherein, recession is coming. We don't know when it will come. And if I get out of the market, then you lose this whole upside of 25%, 30% in the stocks that you own on your portfolio. Right? No one has been able to predict the timing of exactly when the recession will come. It's not that market will tell us one finding, okay, is now from June 28th, we will get into recession. I wish market would say that to us, but it will never, right? So if you're still nervous, and I'm like, yeah, I don't want to collect it, but I don't want to expose myself to to unlimited or rates on downside. This is what I would rather use it. Add only a limited, I would say, risk on the downside. Plus, collect some decent amount of a premium and be able to sell it if it goes higher to 90. I don't know what to call this though, but this is something I track it as, okay, on the long stock, against the long stock position, I'm selling a put spread and a covered call. Put spread will allow me to buy the stock at a lower price, but if stock falls down to $30, then I can sell it back at 55, right? But if stock goes higher, then this is the profitable situation for me. Right? Now, if you end up in a situation wherein you don't want to get get out, you don't want to be out too soon and avoid a seller remorse, convert it to iron condor, buy a call here. Or do this one contract when you own 200 shares of AMD. Right. So again, this is covered because we have a naked on the call side here, but we own the shares. And this gives me what, 1 point, I hardly sacrifice much premium on this. So you really don't have to worry about it. What if the AMD goes down 50%? Am I adding huge risk? Not. I mean, you contain your risk. Your risk is only max you add is only till $20. You can always sell it back at 45 on this option trade. So these are, but you are able to collect almost 1.5% for a month, which turns out to be, if you do month after month, let's say take a couple of breaks for 2 months, still 12%, 15% decent, I would say, your own dividend stream. And what not to like it? I mean, market generally returns 8 to 10%. And if you're able to extract some 10, 12, 15% of income stream on top of it, why not? At 2022, again, do it only if you want to hold AMD for a long term. Right? If you want to hold AMD for next 10 years, and tomorrow it goes down to 40, you don't want to sell it, then why not sell the covered calls? Because anyway, you wanted to hold this in your portfolio. So for those, your long-term holds, these a few strategies have worked out. Hopefully it will work out. Try it out. Again, not an investment advice, but few things that have helped me to stay in the market and chip in slowly on the cost basis. I mean, it won't give you the gains that you would see on Twitter, people talking about 200% gain using options, 400% gain using options. Those lottery tickets is something which I don't do it, but these are the stuff which is what I generally focus on. All right, let me address. So that's wanted to talk about these covered strategies. Of course, there are a lot more other option strategies that you can do with or without having the long stock in position. Some other day we can talk about it. But today I just wanted to talk about many of the retail investors are generally buy and hold investors of the long stocks. What do? You're nervous. Recession may come, may not come. Who knows? We have talked about soft landing, hard landing, no landing. When landing happened, I don't know. So what do we do in that case, wherein at least give me myself an opportunity to just make a little bit of our money month after month? Is few of these strategies I thought I'll share with you guys here today. All right, let me address these questions and then we'll call it a day. My thinking was collecting put premium or buy stocks on sale rather than giving up in long calls. Yeah, I generally don't buy long calls. There may be times when buying a long call may work out if your IV is really low, right? But if I look at my career on options, very few long. I mean, I do very few long calls. But even out of that, it'll be very few of them will actually work out because the risk is always overstated. On a long term, risk is always overstated. So really have to pick up. And sometimes this is what I feel. I also attend some other meetups. Then I see people talking about, you identify this and then you can pick up a lot. I mean, this is like saying, if you can identify the numbers of your Powerball, you can become multimillionaire. Oh, hell, of course. But that's the hardest thing to do in the stock market, is to figure out what the market is going to do. The people who are billionaires, people who are like, Paul Tudors, people like Warren Buffett, Howard Marks, Stanley Druckenmiller, none of them have been able to predict what the market going to do. And then I don't want to depend on a strategy which says, if market will go higher, so let's go and buy out of money call, because the percent wise, you'll make 200%, 400%. But what people don't talk about it, other 99% of the trades where they lost everything. So yes, my preferred criteria is to sell rather than buying these long calls. Sam, as the New York Times, you can use a tax refund to buy I bonds, but should you? Well, it depends on if you want to hold I bonds. I mean, you can use tax refund to buy more than 10,000. If you just buy online, there's a limit is only 10,000. You can buy additional 5,000 of I bonds by getting your refund. Instead of getting a cash refund, you can fill up a form and tell the IRS that instead of giving you cash, they basically give a I bond.
Vivek, talk about it. It's just that people are discussing it now.
Oh yeah, people are discussing, where right now it's a tax season. So people will be filling up the tax form and they say, should I buy more I bonds? So that depends on if you want to hold more I bonds, right? There are things that we talk about, pros and cons of I bonds. If you eventually decide that you want to own I bonds, then this is a decent, a way to to put in another 5K into I bonds. Why only this? There's another method that we talked about when we did a deep dive into I bonds, is the gift box, right? You can buy for your, let's say, spouse, for your friend, or whoever, you could buy a I bond right now, put it in a gift box, start that I bond start to earn current interest, and you can gift it to the person in a year when they are not buying the 10,000 limit I bond. But that, like maybe a year, 2 year, 3 year down the line, when the interest rate will be lower, that's another way to put more into I bonds. But I think as an investor, you have to decide. Me personally, I'm not buying. I only bought just one, just to get a feel of the process, because you can't sell it before a year. You sell it before 5 years, you lose 3 months of interest and all that stuff. So I can find a better use for my money, but up to you. But this is a way to acquire I bond. Bob, for adjustment to trades that go against you, have you ever tried layering spreads on top of spreads? Not the spreads on top of spreads, Bob. Okay, no, I shouldn't say that. But let me clarify a couple of trades which sometimes I've done. But that's not from a management perspective, but that was a strategy going into the trade. That was a strategy. Is, say, if I have sold, say, RN fly, right? And say whatever ticker, or the most favorite ticker, and I made a few $1 million on this ticker, is XYZ ticker, right? I guess everyone has made a few $1 million. So on this ticker, if I've sold, and if I want to have, let's say, total risk on an option trade of, let's say, $2,000 or $2,000, if this is what I generally want to limit my risk to a particular ticker, generally what I do is I will sell one in which I have $1,000 risk only, because I do want to give myself time and for stock to make a movement in case if it goes against me, to add some more. So that's what I call layering. So there's a difference, at least for me personally, I make a difference between layering and adjusting. So if I have not yet reached the limit of a maximum exposure that I want to have against a ticker, and let's say when I did this, stock was at 100, and let's say that stock moved to 110, right? At 110, I could layer in another option trade of a similar risk. So let's say that probably answers your question on, I don't call it adjustment in my lingo. I call this as a layering because, hey, to start, when I entered into this trade, that was my strategy, that if the trade goes against me, I have kept some dry powder to layer on top of it. Now, this will again, recenter the trade. Now, when I'm looking at, let's say, other way around, say I've already exhausted. Let me get rid of this one. Delete. Oops. Oh, sorry. It's not this. Oh, gosh. Hold on. Let's erase this and go back to our first one. Is all right. Let's say going back to the same one. My maximum exposure that I want in a trade is only $2,000, or on a ticker is only $2,000. Favorite ticker XYZ. I already, this is at 100 and this is at 80. So I already got max exposure. Right. Say if this is the final position, I don't want to add any more risk to it, and the stock moves to 105. In this case, I'm not gonna not add a layer to it because I already had reached the maximum amount of exposure that I want to have in this ticker. In this case, I will do what I call as adjustment, is I'll roll up my put higher. So that's how I differentiate between adjustment and layering. So I will not layer on this one if I'm already had a maximum exposure. But if I had a trade in which I did not have a maximum exposure and I did a spread, then I could layer and add another spread. Well, let's say I've done those two and the stock still goes against me, and then I'm not going to layer anymore. Then I'm going to start adjusting my trades by, moving the opposite side, the unchallenged side. So that's what I follow. I don't know what others follow. It's more about risk management. Right. Cool. Any other questions, either on options or on earnings? Sorry, we didn't go through the markets today. I thought I'll spend some time on these covered strategies because a lot of chatter around the market. Recession is coming, not coming, making us nervous. And what do you do for the stocks that I hold in my portfolio? Here are a few things that you can try it out. Again, at your own risk, understand your risk profile, understand you as an investor. Works out great for me, but if your profile is a little different, you start to have a seller remorse, then you have to change your own strategies. All right, with that, sorry.
Yeah, I stepped out for a minute. So what was the conclusion on Shopify and also recession?
A recession, I have no conclusion because we don't know when the recession will come. Looking at the history, there has never been a time period where we had these conditions and we did not have a formal recession, right? But could this time be different? Who knows? Listening to most of the market pundits say recession will come, right? Now, coming to Shopify, we talked about it. Right now, the Shopify concern is they are into investment mode, and that's why their margins were under pressure. But I am a shareholder. I want to hold Shopify and use some of these strategies to reduce the cost basis. So right now, I don't see huge concern on Shopify. Market didn't like it because of the margins were down, but they were down for a reason. They are investing in their fulfillment network. Yeah. But it's not a cheap stock. So I mean, it's trading at 10 times the sales, which is not cheap, given the current conditions. So that's
Thank
that's
you.
my thought.
Thank you.
Mhm. All right. Cool. Okay, then I guess that's it for today. And have a nice time in the markets next week. And we'll meet again next Saturday. Goodbye, everyone. All right. Hope you have a profitable week. Again, I'm cautious, and that is why I use these to keep on reducing the risk. We never know, and we don't know what market will do in the short term. With that, let's end right here.